Good morning or good afternoon, depending upon what part of the country you're in. This is Mark Lilly, and I'd like to welcome you to this third webinar this week in the series of Rethinking Managing Production. The other two, which you may or may not have been able to attend, is scheduling and material planning. So costing is certainly both of the others are very good, and I encourage you to attend or ask for a recording of either if you haven't been to those also. The costing one is probably my favorite one because it's just such a huge kind of lever in manufacturing companies to help boost performance, and you'll see what I mean by that as we go along. It's also talking about some concepts that folks may not really have been introduced before because of kind of the status quo. So that's kind of fun as well. So let's talk about costing. How do we measure past success in a manufacturing company, right? Well, typically what we're going to do is for the previous month, we're going to calculate the profitability as the total revenue, right? Minus out your cost of materials, cost of outside services, your labor cost, and certainly any other fixed costs or overhead, right? That's going to get the profitability of your company. So the company profit is your total sales minus those four cost categories. How do we measure the profitability of a particular job or work order, right? So, well, we kind of do the same thing, right? Look at the total selling price, assuming that job is, linked, hard allocated. We may try to soft allocate in some fashion to get the revenue value of that job if it's not directly linked to a sales line. But we find the revenue of that, and there again, we subtract out the cost of materials used to make that job, the cost of outside services for that job, the labor cost to make the job, and an allocation of overhead to make that job as well, right? So what do we know here? We certainly know the cost of materials used to make the job. If ideally we have an ERP system of sorts that can show us that. If not, we probably walk over to our accounting area and figure out from specific vouchers or what have you what the cost of materials and outside services were. So it's typically the actual costs are typically a known quantity. Labor cost is sort of a known quantity if we're tracking time against the job. Some companies do well, others, but even if you're doing really well, in terms of tracking time against the job, is that really what it costs you to make that product, right? And then we talk about overhead and allocating overhead to it, which is typically based on a formula, oftentimes a percentage from the labor cost, which kind of said maybe we're not incredibly sure on, number one, our accuracy of the labor time to it, or the allocation of it as well. So that's kind of here where we're going a little bit. But your job profit, the profitability of a job is the sales revenue for that job. Subtract out those four cost categories, right? That's our traditional method of job costing, product costing, product line costing, right? Probably any sort of manufacturing costing at almost any level within the manufacturing company. So how do we use this information? Well, when we're quoting things, we like to estimate a profit margin, right, based upon those four cost categories, the price, and then to set a price that we would establish a healthy profit margin for our company. And then we're also going to use that information, right, that margin to determine, or the potential margin, estimated margin to determine whether or not we're even going to take the job, right? And then once we get the job and we do an actual analysis, we use that same formula to determine, right, your sales revenue minus those 4 cost categories, and look at that profit margin to determine, which jobs were the winners, which were the losers. Okay? And that is the majority of manufacturers' type of costing analysis. What's the typical pricing strategy? Well, here again, we're gonna quote a price that maximizes the profit of each job as much as possible, right? That gives us a desirable profit margin to certainly cover and exceed those 4 cost categories, right? And why would you do anything different? It just doesn't make sense. So what happens? Well, we may lose in some competitive situations because price is too high. Or we may also refuse work if certainly the margin isn't there, right? If it's not, or if it's relatively low. Certainly anything with 0 profit margin would be silly to take on, right? So we're going to, but low profit margins too, we'll probably refuse those and let a competitor, take those types of jobs. So, kind of independent of that, we talk about what the valid measure of success is. If the profit of a job is valid, then does it make sense that the total profit margin across all jobs adds up to the company profit? Does that make sense? Does that happen? So if I look at this on a job by job basis, and add up each of the profit margins for each job, does that equal my total company profit? No, not even probably not. No, it's not going to, and probably never will, right? Because the sum of the labor and overhead allocated to each job that way, just number one, it doesn't equal the total company labor and overhead, right? And even if it did, even if it equaled the total company labor, maybe you could backward calculate it and force it in there. That way, whatever allocation you're applying isn't going to be accurate to a specific job, right? Because the reality is that we're paying for labor and overhead, and it's essentially the same on a month-to-month basis, right? So when we use these costs to allocate certainly overhead and to some degree labor, then it's leading us to make potentially some bad decisions. Okay, so in other words, we don't really have good visibility of what our profit margin really is. Okay. So the analysis, or quoting certain prices, may not be really what we want to do, right? In terms of maximizing our profitability. Looking at winners or losers based on these profit margin calculations may not be giving us a clear picture of really which jobs are contributing most or best to our company's health, right, and performance. So then it goes even further into making investment decisions, right? If I'm using these allocated costs to decide, on whether it makes sense to buy a new machine, for example, or hire a person or different people, or let people go for that matter, is it skewing my decision making that way? Product mix in terms of which jobs to work on next, or which types of products or product families are truly contributing more to my bottom line, right? And then if I wanted to prioritize work, even to maximize my profitability, do I have true visibility of that using this traditional cost accounting method of profit margin based on material, outside service, and this allocated labor and overhead? Okay, so that's really what we're targeting here. So instead of accepting the fact that these are skewed costs, right? This is giving us a skewed picture of what our profit margin truly is. Let's look at a better way to view costs. Okay, something that that is based in reality, that we know is true, and we know certain costs, right? As I mentioned, we know material and outside service costs. We know job-specific material and outside service costs. Right? So in that fashion, it's a good number to use. We know the sales number, obviously, from the sales order. So let's use that information to find the truth. Okay? Using labor and overhead in these cost calculations is skewing your perception of what your true profit margin is, because you can't truly know. Number one, you can't truly know how much labor, how much overhead truly was spent or allocated on that. But even if you did, even if you could pin that down perfectly, it frankly doesn't matter, because you're paying for your labor and overhead anyways, generally speaking, on a month-to-month basis, right? So whether you took this job or not, you're still going to have the same labor cost and overhead cost in that particular month. Okay? So therein lies the opportunity to view things a little bit differently. Let's take a look at an example. Customer wants to pay us $2,000 to do a particular job. They want it next week. We happen to have plenty of available capacity through the resources, through the work centers that this job would need. Okay, they're not bottleneck constrained. The material and outside service cost for this job is $500. We calculate the labor and overhead out to be $1,600 for the job. So by traditional product costing methods, this would show we're going to lose $100 if we do this job. Well, that's ridiculous. Why would we ever take that job? We wouldn't. But the fact is that capacity is not being used. We're going to pay for that capacity anyways. You're going to pay for those people in those departments. You're going to pay for those machines. You're going to pay for the electricity and the lights overhead in those areas. The only additional cost the company's going to incur by taking this job is $500 for the material and outside service costs. Taking this job results in a contribution margin, okay, a direct increase in profit of $1,500. Of course, we'd take that job. But again, the key is having visibility of our capacity. If I was already, sold out in my capacity through the month, and I had, other jobs going through there, then obviously it wouldn't be a good idea to take it. Or if they could accept a 3 or 4 week lead time, then maybe it would. So we're going to look at contribution margin analysis. And this simply says the contribution margin is the revenue minus those total variable costs, material and outside service, essentially. Net profit then is the total contribution margin minus your total operating expenses, labor and overhead that generally you're paying for, and generally the same amount on a month-to-month basis. That's your net profit. We can view this as a company at the company level, and or at any other level through costing, right? Product line, specific part or product, right down to the job or work order. So company profit is total sales minus these 4 cost categories. Contribution margin is total sales minus material and outside service costs. The company profit is the total contribution margin minus those relatively fixed costs, labor and overhead we're paying for anyways. The neat part about this is if I can find an opportunity or opportunities to increase contribution margin, what happens? There's a direct one-to-one correlation between increases in contribution margin and the bottom line of my company, the total company profit. Okay. This is where we find a lever point. This is where we see the power of looking at costs, making decisions based upon contribution margin analysis rather than traditional product costing. How do we do that? How do we find these opportunities, right? To emphasize the point, I'm going to walk through a little example that talks about looking for opportunities to improve contribution margin versus cost cutting, cutting costs, okay? So I've got a little company here. We've got, I want to improve the profitability. It's currently not bad, but I've got 100,000 in sales. My raw material costs are 40,000. My contribution margin is sales minus raw materials, or 60,000. My direct labor and overhead, you know, generally what I'm paying for every month anyways, about 50,000, 12 and 38. Okay. So my net profit is $10,000. I want to improve my profitability. So I'm going to cut my costs by 25%. I'm going to cut my labor costs by 25% to improve my profitability. So in doing so, my sales is generally going to stay the same, which probably wouldn't be the case if I'm cutting a quarter of my company, but that may be another topic. My raw material costs are the same, contribution margin the same. So there's my cut in direct labor from 12,000 down to 9. My operating expenses probably would go down a little bit as well, but for sake of argument, we're going to keep those the same. And my profitability goes up by 30%, $13,000, pretty good. Well, what if instead of, and clearly cutting my labor by 25% is likely to have an impact on morale in the company, to say the least, and performance otherwise. But again, won't digress. Instead, let's look at looking for opportunities to improve contribution margin by 25%. And what would that do? Now, when you look at the sales number, the sales is increasing, but not necessarily because I've found more sales, which may be the case, but I'm assuming I've got a sufficient backlog whereby if I'm finding opportunities to improve my ability to deliver those sales sooner, then I'm going to increase the sales that I'm recognizing in a particular time period. Okay, so that increases. So I'm finding opportunities to increase my contribution margin by 25%. So my contribution margin would go from 60 to 75,000. The sales number, recognized sales number as a result of doing that goes to 125. My raw material costs go up 25% accordingly. So my direct labor and overhead is staying the same. So my increase in this contribution margin of $15,000, as I mentioned, because of the definition, the way it's defined, that's going directly to my bottom line. I just increased my net profit by $15,000, 150% increase. Okay, 5 times what a 25% cost reduction would do. Where does it make sense to look to improve the performance of our manufacturing company? Right, okay. Total contribution margin, total sales minus material and outside service. Company profit, total contribution margin minus what you're already paying for, labor and overhead. Okay, the way we want to see our company here is that your company is a contribution margin generating machine. Okay. You have a building, you have people inside the building, you have equipment, machines, departments, benches, resources in your building. Material and outside service comes in that you pay for. Okay, you're already paying for your labor and overhead. You're already paying for your resources to do what you need to do. Now it's a matter of doing more of what you do well, and that is getting material in, adding value to it, and generating contribution margin. This is how we want to see our company. It's a contribution margin generating engine. We can go down to the job level now, so that a job's contribution margin is the sales value of that job minus material and outside service costs that we're paying for. Again, we know with certainty, we can find out in our company, again, hopefully, and if you've got an ERP system, you can probably just click on a couple buttons and find out what those costs were per job. If you're not sure, go to accounting. They have that information. You know what you paid for material, you know what you paid for outside services. It's no complicated allocation algorithm you have to figure out. Does this add up? Right, we looked at this before with job profitability based on traditional product costing. With contribution margin analysis, if we look at the contribution margin of every job and add those numbers up, does that equal our company's total contribution margin? Which then subtracting out our total material, total outside service costs, does that equal our total company profit? Yeah, it does. It does, because we know these costs for certain. And what's neat about this is if I can find opportunities to improve the total company contribution margin across all jobs or in any one job, and that's going to be additive, directly additive to my contribution margin, which is a one-to-one correlation and directly additive to my company profit. Okay, I think you get it. So time for a little break. I'm going to take a sip of water. So that's the big concept here, and we're going to get into now. We're going to dive into a little bit of detail and get a little more heady with it. But that's the overall approach, and viewing costs differently with this concept of contribution margin, really at any level within the company. Okay. All right. So let's take that now, and let's take the next step. And from here, we want to look at whether first we want to figure out whether our company is market constrained or internally constrained. Okay, meaning what's controlling the amount of contribution margin that my company is generating? Okay, is it the amount of sales? In other words, could I easily handle more sales and directly increase my contribution margin that's pumping out in a given week or month, right? Or do I have an internal constraint? Is there a machine or a group of machines, or is it people that's limiting how much I can generate based on from what I have on a backlog? Okay. So I'm sure you can probably answer that fairly readily, just understanding what your company's situation looks like. So if you're market constrained, okay, then you can very simply look and say, by job or by product line or what have you, and see what's the revenue, what's my total variable costs, again, material and outside services, and calculate a contribution margin. You could take all your sales orders right now and the jobs that are producing them, right, and figure this out. So you could see what are the winners and what are the losers. And most of the time, usually when you're looking at things this way, most of the time your contribution margin is, you can see some of the bigger orders certainly have the bigger contribution margin as well, right? But then, you look a little harder and you realize, well, some jobs have relatively lower or higher contribution margin, even compared to their revenue, right? So I've got even though this product A is $145, just under product X, I'm making, percentage-wise, a fair amount more on the contribution margin, on profitability, based on that. Okay. So this is very simply just if I'm market constrained, I pretty much want to stop here. Meaning I don't have any internal bottlenecks. So really, whatever I choose to work on, whichever sales orders I choose to focus on to complete for this month, is going to be my contribution margin that I'm going to recognize for that month. Okay, so pretty straightforward. It gets a little more complex and a little trickier, but a little more interesting too when we get into a situation where, well, I do have bottlenecks now, a bottleneck or maybe multiple bottlenecks in my company that's controlling the amount of contribution margin that my company can generate. Okay, so here what I want to look at is, number one, I want to be able to identify what my bottleneck is. Okay, now if you don't feel you probably can figure that out. You probably know that by walking around your shop, or just kind of living through getting orders. Where do you need to expedite orders through, for example? But if you don't, certainly, or a tool, if you view the webinar and scheduling, you'll understand how we can help you identify not only what your bottleneck is today, but what your bottleneck's going to be in the future. And that's where this can get fun as well. You kind of have that visibility of what's going to be your constraining resource in the future based upon your backlog of orders, right? But regardless, you want to identify your bottleneck and then talk about, then calculate how much time is needed for this particular job in the constrained resource. Okay, so now the idea is what's controlling how much contribution margin you can generate is that constrained resource. So now it's not just simply how much contribution margin is the job pumping out for me. It's how much contribution margin is my bottleneck able to pump out on this particular type of part or job, right? So now the picture changes, okay? Because what was my highest contribution margin job right here, part B, takes 15 minutes on my bottleneck, right? So the actual contribution margin that it's generating per unit of time, in this case per minute, is actually lower than product Z, which has quite a lower contribution margin, but only takes 5 minutes on that bottleneck. So I'm actually generating $17 in contribution margin per minute if I focus first on my product Z type of job. Okay, and in that fashion, I can increase my profitability and have the visibility of which jobs are going to contribute most to my company's health and profitability in this given time period. Okay, let's take a look at an example. And this is a great example to contrast the traditional product costing method and approach and decision making with contribution margin analysis. Okay. So here I've got a little company. We make shirts. We make women's shirts. We make men's shirts. Weekly demand, I've got a good solid backlog of demand for shirts. My customers want 120 women's shirts and 120 men's shirts. I get more in revenue when I sell a women's shirt than a men's shirt, slightly. And the raw material cost is less on a women's shirt than a men's shirt. Both shirts go through first cutting. When I get the material, it goes through cutting, then it goes through sewing. A women's shirt only takes 2 minutes to cut, whereas a men's shirt takes 10. But once it gets over to sewing, a women's shirt takes 15 minutes to sew, whereas a men's shirt only takes another 10 minutes to sew over there. So my total processing time is 17 minutes for a women's shirt, 20 minutes for a men's shirt. My operating expense, my total labor and overhead for the week is $10,500. I've got a capacity over, I work at, I think this is an 8-hour week, 40 hours a week. My overhead rate is constant. And again, as I described, both products have the same routing, that is cutting then to sewing, but different times in each department, okay? So from a traditional product costing standpoint, which shirt should I make first with my capacity? Okay, if I calculate it out, I don't have capacity to make all 240 of these, all 120 of these, 120 of these. So which ones should I make most of first? Well, from a revenue standpoint, would clearly say that I get a higher price when I sell a women's shirt. So, yep, 105 versus 100. Lower cost, raw material cost certainly is lower. Even the time to produce it overall is lower. So, yep, women's shirt's got to be it. Higher margin, well, higher price, lower cost. Yep, that's going to give that to women's shirts. And overall labor and overhead. Yep, again, 17 minutes versus 20 minutes. All indications are I need to be pumping out those women's shirts first, and then with whatever capacity I have, make however many men's shirts I can. So let's go ahead and do that. So we're going to make 120 all of my women's shirts, and then with the remaining capacity, I'm going to be able to make 60 men's shirts at $100 each. That's going to give me a total revenue of $18,600. My raw material cost with those associated quantities calculates out to $8,400. Here's my gross margin. Here's my total weekly labor and overhead. And that's not a great business model. Not feeling too happy about that. Well, let's look a little deeper. What is my constrained resource? Which one of my resources, cutting or sewing, is my bottleneck? Well, cutting overall takes only 240 minutes in total for all my women's shirts. If I were to make 120 of both of these, 1,200 for men. So cutting is not a bottleneck. So 1,400 required for 2,400 minutes. Sewing, 1,800 minutes for women's shirts, 1,200, total of 3,000. So clearly that's more. So yeah, sewing is clearly my bottleneck. So what did we say in that previous slide? What we want to do is we want to calculate out, we want to identify our bottleneck, and we want to calculate what the contribution margin dollars are per unit of time through that bottleneck. For women's shirts, it takes 15 minutes in sewing. Revenue is $105. So our contribution margin is $60 divided by the 15 minutes it takes in sewing. When I make a women's shirt, I'm generating $4 of contribution margin per minute. When I make a men's shirt, which needs just 10 minutes in sewing, I'm making $50 in contribution margin, but using only 10 minutes in that resource. So I'm generating $5 per minute through my constrained resource. Obviously, the higher the rate, the better. So this is telling me contribution margin analysis with the visibility of my capacity is telling me I should be much better off making men's shirts. Let's see how that works out. I'm making all my men's shirts now. With remaining capacity, I'm able to make 80 women's shirts. So that comes out to 20,000 in revenue, my associated raw material cost, my gross margin, minus my operating expense. Looking good, making some profit on that. What if I want to minimize product cost? Here again, another comparison between traditional product costing and contribution margin analysis. Currently, a men's shirt takes 10 minutes in cutting. I want to spend $100 and get that down to just 8 minutes. Well, what's that going to do? Well, from a traditional product costing standpoint, that makes a lot of sense. I get a total processing time right now of 10 minutes in cutting, 10 minutes in sewing, total of 20 minutes. This would reduce it down to 18 minutes for 10% cost reduction. Absolutely, that's the way to go. But what's really happening? I can't sell more men's shirts if I cutting down to 2 minutes. I still have sewing as my constrained resource for those men's shirts as well. So I've just added $100 to my company investment with really no return on it whatsoever. Okay. What about an example of increasing a product's cost? So this sounds a little crazy on the surface. What if somebody suggests paying $1,000 that would decrease the sewing time on a women's shirt by 1 minute, but it's going to increase my cutting time by 3? A net increase of 2 minutes, right? My total processing time before was 2 plus 15 or 17. Now it's going to be, let's see, 5 minutes in cutting plus 14, so 19 minutes total. That's a 12% increase in cost. That's ridiculous. But what's the big picture, right? Each women's shirt is now only using 14 minutes of our constrained resource, of our bottleneck. What does that mean? That means that the dollars per unit time through my bottleneck is likely to increase. Okay, so sure enough, with the 1,200 minutes available for women's shirts in the week, I'd now be able to do 5 more shirts. 85.7, can't do 0.7 of a shirt, so we'll say 5 more. If that's the case, then now I can make 85 shirts. I'm still maximizing my men's shirts because I still get the higher throughput or contribution margin per unit of time. But now I'm able to make 5 more women's shirts. Okay, added revenue, subtract out the raw material cost, and now my gross margin is 11.1 minus my operating expense, which stayed the same. I've doubled my profit with $1,000 investment. I've got an ROI in that fashion of less than 4 months. Sounds like a good decision. But traditional product costing would definitely have prevented me from doing something like that because it looked silly from that standpoint. So I think you've seen some examples of how this works. How can you put it into practice? A number of ways. Just doing some of the analysis that I showed. Again, you should be able to get a lot of this right out of your ERP if you have that type of information. Even if you don't, on a monthly type of exercise, you can probably go to your accounting department and get most of these numbers, put together a spreadsheet. Looking forward, what you can do is kind of budget for the coming months. Certainly understand, what that monthly overhead and expense, labor expense is going to be. Kind of budget for what sort of profitability you've had, what sort of profit you might like to have, and then look at those contribution margin numbers, particularly of your backlog, and see how that's coming in. What decisions are you making to produce which product? How are you perceiving? How are you calculating out what your winners and losers are? Right? Are you accepting business that's contributing to the health of your company? Or maybe you've got some you've been doing a lot of work on that, if you look at it this way, may not be the best decision for your company. Okay. And others that have quite a high contribution margin you didn't realize. So it can be a really fun exercise in that regard. And then essentially you want to determine looking forward what your prime resource capacity, what your bottleneck capacity is. Many machine shops, for example, might see, you know, the front end milling machines as the primary resource. So you want to budget those roughly at 80, you know, maybe 75, 80% capacity. You want to keep some slack capacity there for a number of things. Obviously, just from a buffer standpoint, which I think you'll appreciate if you've been to the scheduling webinar. But also from an opportunity standpoint, if you get rush jobs in or jobs, you know, where you have an opportunity to charge an expedite fee, for example, and having that capacity available can allow you to do that and continue to add contribution margin. Okay? So the fun part about this is that we get to look at it's important to see and understand what our capacity is today, what it is going to be in the future, so you can make these decisions. Because anything you get, any business you're able to get where somebody's willing to pay simply over your material cost, right? Material and outside services for processing, all of that contribution margin is going to go directly to your bottom line, right? Now, obviously, you ultimately need to cover your labor and overhead expense, so you don't want that obviously to be a policy across all jobs, but it is a great way to find opportunities where otherwise maybe you've got some older machines that are rarely used that could be used for these types of jobs to contribute to contribution margin. Rush jobs are another good example as well of those. Again, where a client may be willing to pay an expedite fee or more to get it sooner. And if you've got capacity, again, anything above that material cost is going to simply go to your bottom line and contribute to a better financial health for your company. Okay. Visibility of your capacity really can hold the key to implementing this as well, getting a very clear picture on where you have opportunities to possibly greatly improve the financial performance of your company. Some suggested reading. This topic is, I've heard it referred to as value-added revenue, certainly contribution margin. In the TOC, or theory of constraints world, it's referred to as throughput accounting. Probably one of the best books I've ever read on the topic is The Measurement Nightmare by Deborah Smith, she very much comes from a throughput accounting kind of theory of constraints world. But she puts together literally a comparison of financial statements and cash flows based upon both this contribution margin analysis method and traditional accounting, and really very, very eye-opening. It's out of print, unfortunately, so I've looked on Amazon for it. Sometimes it's almost $80 or more. Other times I've seen it for 20 or 30. So I'm not sure what the going rate on the book is these days, but it's very good. Really, any book on throughput accounting will get you close to these concepts as well. With that, I'll open it up to any questions. If you're not comfortable, questions on the webinar, feel free to send me an email, hit our website, and be happy to talk further with you about any of these topics as well. See, I'm looking in the chat and under questions. Nope, not seeing anything. So great. Thanks so much for attending, and have a great afternoon. Thanks all. Bye.